The Indian economy has clearly been the gold medalist of 2023 with a likely 6.5% GDP growth in calendar 23, fastest among large economies. Of course, even the US economy grew by 5% in Q3 and that's helped, but US is expected to slow in 2024 to as low as 1.2% by some estimates. Even global growth is expected to slow by at least half a percentage point versus 2023. So how will India fare on growth, on interest rates, on rupee? Well, I have with me an elite panel of economists and bankers. Samiran Chakraborty, Chief Economist at Citi, Neeraj Gambhir of Axis Bank, Santanu Sengupta of Goldman Sachs and Sakshi Gupta of HDFC Bank. Gentlemen and Sakshi, thank you very much for your time. Hope it's a grand new year for all of you. Let me start with you, Samiran. Exactly that, the growth question. Of course, we've done very well in FY24 with probably 7%. But how's FY25 looking? Will global clouds bring us down drastically?
Good morning, Latha. I think the broad domestic fundamentals on growth are doing quite fine, although there is a distinct composition difference that we expect the fourth consecutive year when investment growth will be surpassing consumption growth, which has not happened in India's history in the past. But there, on the headline growth number, there could be a modest 50 basis point lower GDP growth. That's primarily because of global growth slowing materially. Citi global economists expect global growth to fall from about 2.7% in 2023 to 1.9% in 2024. That headwind India will have to deal with, and that's primarily the reason why we expect a 50 basis point kind of a slowing in growth in FY25.
But Shantanu, let me put in some domestic constraints as well. One, the fiscal deficit will have to be brought down. That was quite a steroid in the last 3 years when we did very well. Assuming it comes down to 5.5%, that, that kind of capex growth may not be there. And secondly, as of now, there isn't enough conviction that the government capex has handed over the baton to private capex. So, your estimates of growth.
Yeah, thanks, Latha. Exactly because of the fiscal drag, we think that growth will be lower. We are sub 6.5% for fiscal year 25. We are more optimistic on US growth in particular. We think that US growth is printing north of 2%. But given the fiscal drag and especially the capex, as you said very correctly, has to come down. You cannot have capex growth in the region of 25-30% that you have seen in the last 3 or 4 years. This is going to be at best growing at nominal GDP growth rate or maybe even a little bit lower. So the private capex recovery, in our view, is more a second half story than the first half story. The first half story is still going to be elections. And therefore, our growth estimate is slightly lower than 6.5% for fiscal year 25.
There are a good 60% of people in our poll who are expecting between 6.2 and 6.4. So you have a lot of support, Shantanu. On the same issue, Sakshi, I mean, the other point that do you see private capex picking on the baton at all? There seems to be, of course, bits and pieces, but can it really fire growth, private capex?
Yeah, Latha. So our estimate for next year is for growth at 6.3%. Growth is going to slow down from the global slowdown. And of course, we are going to see some amount of fiscal drag. I think on top of that, you will also see that monetary policy remains tight for at least the first half of the year. And, even if we get rate cuts in the second half, they are going to be very, very gradual. So all these factors will weigh on growth. I think on the private capex side, I don't think that, in the next 2 quarters, we are going to see a significant revival. And I think we are not going to see a broad-based pickup in private capex. Once the election uncertainty is over, I do think that by the second half and towards the end of the second half of next fiscal year, you might start seeing more broad-based signs of a private capex revival. And why I say that is that capacity utilization rates are high in the economy. We are going to see a consumption slowdown, but not a collapse. So I think there will be a support on the consumption side as well. And I think that as you start seeing some slowdown on government capital expenditure, it should open up space for private capex to come in to a greater extent. But I would say that that story is going to be towards the end of next year, not before that.
Time permitting, I'll come to the consumption story as well. But Neeraj, before that, some of the Reserve Bank's actions are not exactly helping credit offtake. We have seen a spate of deposit rate hikes because the Reserve Bank has kept near-term liquidity very tight. We've got a report from Samiran, just a few minutes back, pointing out that this year, even at the end, December 31, we didn't see interbank liquidity going into surplus. It was a huge deficit of, over 1 trillion rupees. So are you seeing deposit rates continue to rise and therefore lending rates?
So Latha, on liquidity, I think Samiran's take is absolutely on the point. The government spending has not kicked in as much as expected, and which is what kind of leading to the interbank liquidity in the deficit, even though the overall system liquidity continues to be about 2 trillion plus surplus. So it's lying as government balances with RBI. While the government has been spending, but if you look at the net difference between the receipts and expenditure, I think it is a bit sort of muted. And expecting that in the Jan to March quarter, we will see some of this spending come through. And if that spending comes through, then obviously it will have some bit of a moderating effect on the interbank liquidity deficit. Otherwise, we expect the deficit to continue. I think the system liquidity will continue to be in a bit of a tight mode. Call rates or overnight rates continuing to be at the higher end of the corridor. And that obviously has an impact on the short-term rates, money market rates, as well as the deposit rates. So at least for the next 3 months, I do feel that the deposit rates are likely to stay a bit elevated, particularly on the bulk deposit sides and on the CD rate side, where which is basically a market-driven sort of phenomena.
Very briefly, Neeraj, do you expect cost of capital for industry to rise in the first half and in the second half? How would you say?
I think it is. I don't see a material change from here until the end of I would say June at least. I see a very range-bound bond markets in terms of yields. I think deposit rates, depending on which part of the deposit segment you look at, there could be some movements here and there. But broadly, it's a very, very stable, rate regime that we are looking at currently.
Okay. So not endangering cost of capital. But Samiran, let's therefore bring the question to rates. The US market is running away with even expectations of 5 rate cuts. Your sense about how rates are headed in India, both the official rate and the yields?
So Latha, monetary policy, in our view, would be a 3-stage process in 2024. The first stage will be where this divergence in banking system liquidity and durable liquidity will come closer, and that would imply that the weighted average call rates will come closer to the repo rate rather than staying at the MSF rate. So this will be the first stage. This should be followed by the change in monetary policy stance, as the December policy minutes suggest that this was inactive consideration in that meeting. So we expect that the stance change happens in April. And then with a little bit of lag, maybe in August, when there is more clarity on the monsoon, we see a shallow rate cut happen of about 50 basis points in 2024. That would imply that the softening of monetary policy stance, along with the global bond index inclusion related inflows, has the potential to take 10-year bond yields down closer towards 6.5% by end of FY25 is the view that we have right now.
Okay, so that explains the rate cuts, but that will depend on inflation, isn't it? So Shantanu, the Reserve Bank's own forecast is that in the CPI inflation in Q1 goes down to 5.2, and then it's 4, but comes up again to 4.7 in Q3 next year. So Added to this is we don't know how this Red Sea issue that's pushing up freight rates, and those can have an impact. So, your thoughts on inflation in 24?
Yeah, so Lata, the first half of the calendar year for us looks north of 5%, closer to 5.5% inflation. It really depends a lot on how food prices behave, especially the perishables, and it's very difficult to have a concrete forecast on that. So you'll have a lot of volatility around those prices. Second half of the calendar year, especially in Q3, is where you'll find inflation coming down, largely due to the base effect of last year, and then rising back up again. Overall, we are projecting 4.7% for the fiscal year 25. But I think on the rates front, overall monetary policy, there's a combination of a friendlier Fed. We are forecasting, as Goldman Sachs, 5 rate cuts in 2024. There's ongoing disinflation. Oil prices are lower than where our forecasts have been earlier. So we've revised our oil price forecasts lower towards 80. And we think that US growth is still solid. So you are going to end up probably with quite a bit of flows because of the risk-on environment, especially for emerging markets. And that will help ease the liquidity situation Q2 onwards if the RBI chooses to ease liquidity. So it's very easy at that point of time to absorb dollars in spot and just create liquidity and not keep it as tight as what it is now. In terms of the process, though, I agree with Samiran. It's going to be a process where they first start easing liquidity, then go for a change in stance, and then we also have a pretty shallow rate cutting cycle, only 50 basis points in calendar 24.
Okay, I'll come to the other economist in a minute. But since bond inclusion is so much the conversation, Neeraj, how do you expect this to impact yields? Do you see a combination of US rate cuts and the coming in of this money and buying away Indian bonds, bringing yields down substantially? I mean, are we seeing sub 7 very soon for the 10-year, well before June? And does it go all the way down to 6.5 rate range this year?
So I think for the first half of this calendar year, I think we will be somewhere close to 7 to 7.25. The reason I say this is that we've already seen about $8 billion worth of flows in the last year, particularly $4.5 billion in the last quarter. And the bond yields have actually remained very, very stable. They've been very range bound between 7.25 to say 7.35, 7.40 level. I don't see this flow of liquidity into the system creating a large downward pressure on the yields as such, because we'll also have supply from the government. I think the next fiscal borrowing program will start from April onwards. In fact, we will have to see what the calendar looks like at the end of February. And in the budget, what kind of borrowing program the government announces. But the market, there will be supply for market to absorb. And this extra demand will obviously be spaced out over a period of time. It's not going to be one shot. So I think at this point in time, I don't expect the 7% level to be breached over the next 3 or 4 months. Bond yields will largely depend upon what the view on the policy is. And as I hear the economists say that it is likely to be a very shallow rate cutting cycle, maybe biased towards the second half of this year. So as and when that expectation materializes in the market, we could see potentially a move towards 6.5, 6.75 in the second half of the year. But for the first 6 months, I think it's in the range of 7 to 7.25.
Well, I have to take a break, but how will this large inflow of bond funds into India impact the rupee, impact interest rates? All those questions after the break. Welcome back to Outlook 2024. Our economists expect that growth is going to slow down a wee bit. But the big cat among the pigeons is going to be this bond index inclusion, which could bring in well over 2 lakh crores. And who is to say that we may not be included in the Barclays Bloomberg index as well? And will that mean more inflows? What does that do to the rupee and to interest rates? I have with me Neeraj Gambhir of Axis, Sakshi Gupta of HDFC, Samiran Chakraborty of Citi and Santanu Sengupta of Goldman to discuss all that. Gentlemen and Sakshi, thank you very much for your patience. Sakshi, just that. What is the Reserve Bank expect to do when this money flows in? Do you expect MSS bonds, etc.? And what will it do to interest rates and the rupee?
Clearly the central bank over the last 2 years has maintained the strategy of, building up their reserves. They have been, absorbing a lot of dollar flows. Their intervention on the rupee has been two-sided, and more recently we've seen that despite the appreciation we've seen in some of our peers, the rupee did not see, a similar amount of appreciation, and that's perhaps due to RBI intervention. I think that going forward, clearly, yes, with the sheer amount of inflows that are going to come in, both because of the inclusion in the bond index, as well as some amount of, positivity towards India and the emerging market basket, we could see, an appreciation bias for the rupee.
Okay.
That being said, I think that the RBI will continue to intervene and absorb some of these dollar inflows, because I don't think that they would want significant amount of volatility, be it appreciation or depreciation, to come in. So I think that we will see foreign exchange reserves from the central bank go up further next year, and I don't think that the rupee would appreciate by a significant amount, although there will be an appreciation bias, but I think that we will see some amount of resistance coming in from RBI's intervention of absorbing a lot of these flows.
Okay. I know it's a tough thing to guess, Sakshi, thanks for that. But Samiran, actually a similar question to you. Do you expect that the Reserve Bank may have to take recourse to, MSS or something? Or how will it tackle the likely flow of money? And, we've been used to this 83.30 for God knows how long. So I can't even believe there will be a rupee appreciation right now.
In our view, what's happening is that RBI is putting almost equal emphasis on three things: price stability, financial stability, and currency stability. And that's why we are seeing this exceptionally low volatility in the INR markets. We don't think that's going to change in a very dramatic way in 2024, because RBI has both the willingness as well as the ability to maintain this, given the kind of FX reserves that they have. And luckily for us, if our DXY view is correct, that the range for the year is between 102 to 107, then there's no need for a big rupee move to adjust for valuation concerns.
Okay.
Even the inflation differentials would not suggest something like that. So the RBI can keep on having a relatively tighter range on the currency. But on your other question on sterilization of these inflows that are going to come, our sense is that about 1 to 1.5 trillion of OMO sales could be required, or MSS bonds could be required, on very tentative assumptions about a small reduction in fiscal deficit for next year. Then also there will be enough demand for the borrowing to clear in the market.
Oh, there should be enough demand now that there is another giant set of, investors coming in. Shantanu, just a word on flows and on current account deficit. Current account deficit is not a problem now, but if the world were to slow, would you say that export growth as well as services, as it is, our services exports are only at 28 billion for the last, 9-10 months of this year? They're not growing. Likewise, goods exports, it's around 33 billion. It's not growing beyond that. So, will that be, will we see export growth? And more importantly, what do you say in terms of capital flows?
Yeah, sure, Latha. So firstly, on the export side, services exports was doing about 7% of GDP on average pre-pandemic period. It does anywhere between 9 to 10% of GDP now. Call it 9.5.
Okay.
That is already giving you a buffer. We don't think that grows much beyond in terms of percentage of GDP. So it's reached a peak in terms of percentage of GDP. But even then, it cushions the current account deficit, that you're running from more the merchandise trade balance side. Added to that, you're having about $100 billion of remittances we think that the current account deficit will be less than 1.5% of GDP. We have a 1.3% of GDP projection for 2024. On flows, I think the global rates view changing is quite material, right? Because that creates this risk-on scenario for emerging markets. And therefore, we would expect robust capital flows. One, equity flows probably continues to remain robust with the Fed stance changing. Two, we talked about the GBIM bond inclusion and therefore debt flows. And three, FDI, which has been quite slow this year, will probably turn around also as cost of capital in the dollar markets come down, because fundraising was difficult for private markets with dollar rates at 5.5%. Once that starts easing, you will find more FDI flows as well. So what that will do is that instead of looking at just the GBIM bond inclusion flow in isolation, you'll probably end up with anywhere between $25 to $30 billion of balance of payment surplus, if our assumptions on the current account is right. And that's what the RBI really has to deal with in terms of absorption. Right. Our view is that they go ahead and absorb the flows. They continue to build reserves and treat domestic monetary policy separately. Okay. So they'll sterilize or not sterilize depending on what their domestic monetary policy requirements are.
Samiran, it's just that consumption hasn't picked up. I can see that even in the forecast of you and Shantanu and Sakshi, that people will invest. Capex will grow ultimately if consumption grows. And the K-shaped recovery seems clearly not leading to that. Do you think that will come? And more importantly, do you think tax to GDP ratio is rising so much that the government can do both capex as well as do a lot of income transfers?
I'll try to be brief. On consumption side, I think we are seeing some slowdown trends in urban consumption, while there are some green shoots on the rural side. I don't want to overemphasize them and wait to see how the Rabi crop performs before calling for a full-fledged rural recovery. But hopefully with the rural picking up, we see some overall improvement in consumption. But you are absolutely right that finally the private capex recovery should lead to more job growth, more income growth, and that would be a more durable basis for consumption growth. And the tax to GDP part, I think the problem is not so much the tax to GDP. The challenge for the government is to reduce the fiscal deficit from 5.9% of GDP to 4.5% of GDP in 2 years' time. That's 70 basis point of correction every year. And if you look at the pre-pandemic versus the current fiscal numbers, what strikes you is that the entire sort of increase in fiscal deficit is coming because of capex to GDP increasing from 1.7% to 3.3%. That's a good quality expenditure you don't want to reduce. And to reduce the revenue expenditure or to increase the tax to GDP substantially is going to be a very challenging task. There is a silver bullet always, which is divestment, asset monetization, etc., which can plug this hole. But overall, it's difficult to sustain this kind of expenditure growth with this deficit reduction target in mind.
Thank you very much, Samiran, and thank you all of you for packing in so much in such a short time. The important message is growth will be a little slower, but at 6.2%, we will still be one of the fastest growing economies and definitely the fastest growing large economy in the world. But it'll be an interesting year with possible rate cut from the Fed and a huge bond-related inflow into the country. Thank you very much for watching this special edition of Outlook 2024 Indian Economy.